Hit it. It's Friday, July 28th, 2023, episode 218. I'm Patrick Serezna.
And I'm Kevin Muir. This week's guest is Jan Szilagyi. We have a fascinating discussion about his time working with Stanley Druckenmiller, whether he feels that economics is a social or natural science, and we learn all about his latest market tool, Toggle.AI. Then it's time for Patrick's voodoo magic, where he reads the charts and tells us our fate.
And we end with the no stupid questions and skin in the game. And folks, we might even drink some beers along the way. So stick around. Lena, hop on.
Hello.
What beer are we drinking this week?
So this week we're drinking Mellerud Parade Pilsner.
All right.
Swedish beer.
We have a little bit of a technical malfunction, and I am drinking one of Patrick's Mexican beers.
But I am drinking this. This is a little bit more bitter. We'll talk about it at the end, but it's a nice beer. All right, give us some side effects, bud.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the sell too early swirlies, the fat tail morning bail, and the quad witch stitches.
All right, let's get to the guest.
It's our great pleasure to welcome to the show Jan Szilagyi. He is the co-founder of Toggle.AI. Jan, thanks for coming by.
Thanks for having me. It's great to be here.
Now, we're going to talk about your product and your company, Toggle. It's a hot topic. It's AI and it's got trading. It's going to be a lot of fun. But before we do that, I'd love to get to know you a little bit better. And before the show, we were chatting and you were telling me that you're actually not from the States, even though you have probably one of the most prestigious pedigrees in terms of your in terms of your schooling that I've ever seen. But where did you grow up?
I actually grew up in a place called Ljubljana, which is the capital of Slovenia, of parents that were of Hungarian and Slovenian descent.
Wow. And what was that like in terms of like growing up and then wondering, did you always want to come to the States? Like, was that your dream? Like, when did you decide that, you know what, I'm going to, go to the States and get my PhD in economics?
That's a good question. I hadn't thought about in a while, but it's true that I did always try to move somewhere. I think my horizons expanded as I got older. So eventually I settled on the US. But even from a very early age, I remember thinking and trying to convince my parents that we should move to, I don't know, Austria and then maybe to Germany and so on. Obviously, they didn't want to do any of that. But once I got a chance to do it, I effectively applied to every school I could think of in the US, which at the time was not quite as common as it is now. So, you couldn't just go to your local school and take the SATs. I remember I had to take them on a military base because they did have exchanges between Slovenian and US military, so you could do it there. And that was my path to the US.
And you started off at Yale. And so did you go studying economics at Yale? What was that first degree?
I actually I got a degree in mathematics.
Okay.
And while studying for this, I then ended up, before graduating, also completing enough credits in economics so that I ended up getting also a master's in economics.
As you were doing your undergrad?
Yes. Yes.
Jan, did you have any fun at all?
I did. Like, honestly, when I think back, I thought my college years were super, super fun. Like, there were, you got to meet a lot of people. Also, for somebody coming from Europe, the whole idea of a college campus was pretty novel and very, very appealing. So, yeah, in short, I definitely had a lot of fun. But obviously, I did take the academics relatively seriously.
And from there, did you go straight to getting your PhD, or did you work in between that?
So the story there was a little bit complicated in the sense that I did initially start in the math camp for the program in PhD in economics at Harvard.
Okay.
But about 2 weeks into it, through my college roommate, I ended up getting introduced to Stanley Druckenmiller. And he, at the time, was looking for somebody to come on that he could train in global macro investing. So I told them, look, I'm in a program. I'm not looking to start a job or anything like that. But they said, look, there's no harm in just meeting him.
Right.
So I flew down to meet him. Now, mind you, this was a very interesting time because it was also 2001. So this was in August of 2001. So I went to meet him. I didn't even realize that it was an interview because we spoke for literally about 5 minutes, and he asked me a handful of questions. I went down, said goodbye to the person who had actually introduced me, and I got a call, and they were like, "You're hired." And I was like, "Wait a second, this was not really."
What were the handful of questions about?
So I don't remember exactly all of them, but he asked me a couple of things about like the purchasing power parity and a few other things. And I mean, I guess I must have given some really good answers because effectively they gave me an offer right there and then, which then left me with the dilemma of, what I should do. Obviously, I had spent all this time preparing for the start of the graduate year. And ultimately, I decided that I would take the job and drop out of school. I walked into the dean's office and said, "Look, this is great. Thanks for accepting me, but actually I'm not going to stay and I'm leaving." And they said, "Well, you're crazy. You can't just walk back in. Nobody does this." I said, "I understand, but this is just exciting, so I'm going to do it anyway." And then just as they sort of discharged me, I suppose, September 11 happened. So I wasn't really sure, like the stock market was closed, all sorts of things were happening. So they told me, yeah, no, come down anyway. Obviously, we want you here. And eventually, well, the rest is history, but basically I joined and I stayed there. I stayed there for a year, then explained to Stan that was still an itch that I needed to scratch. And so I came back to that same dean and I said, "Look, now I want to finish this." And he said, as he did before, "Well, you can't just come right back in." I said, "But I'd like to." And then a day later, they took me back. And in 2.5 years later, I walked away with a PhD.
All right. So you actually ended up being, if I got this right, you earned the fastest ever Harvard economics PhD.
I mean, that's sort of what they told me. They were like, "Oh, this is going to be," they were like, "I don't think we've seen anybody come through this so quickly." Obviously, I'm not sure that they keep, it's not like there's an official ranking or anything like that. But yeah, by the standards of the time when, typically the experience is more like 5 years, it was reasonably quick.
And you studied under Ken Rogoff, right?
I had 3 advisors when I was there. Ken Rogoff was my primary advisor. And then I also had John Campbell and Andre Schleifer. All 3 of them were heavily involved in finance. In fact, both Andre Schleifer and John Campbell were also involved with some investing in investment funds. But Ken in particular was extremely generous with his time, would meet with me on the weekends, and ended up being instrumental in my being able to kind of really get through that very quickly. But all 3 of them were invaluable in kind of supporting me in the journey through the graduate program.
And so being kind of from that school, I'm just curious of what your thoughts are of the new economics that we're seeing from the likes of Stephanie Kelton and the other fellow, the MMT. I'm wondering kind of how you square that and whether you think that it's anything new. And I would love to hear your thoughts on that.
I think so. To be honest, I haven't followed it super closely. I obviously have read about some of the developments that they've done. And I think even when I was there, people were always trying to expand a little bit of the horizon. And I think that happened often with either just expanding the scope of what economics would study. For example, a lot of the behavioral economists suddenly started thinking that, actually economics could really explain also school test results, and they could explain things in sociology and so on. But I think it's definitely good that there are always attempts to kind of refresh and maybe bring some new approaches and some new angles to economics. I think that's just a natural way for a field to evolve, keeping in mind that economics has always been a little bit torn between classifying itself as a social science or this innate desire to be seen more as a natural science, almost like trying to, in the search of these almost like laws of physics, looking for laws of economics and so on. So
where do you come down on that?
Look, I think that having some mathematical frameworks is definitely very helpful. I think it can sometimes lead to being able to be a little bit more rigorous about the analysis that you do. But ultimately, I think we have to recognize that there are so many factors that are involved in both macro and microeconomics. And microeconomics, actually, in fairness, does lend itself a little bit better to some of these very strict mathematical frameworks. But macroeconomics, for sure, needs to be a little bit more permissive, and I think should not be constrained to just purely models that then come down to 3 or 4 equations, and you just know that the forecast from that model will be wildly off base in almost any horizon. So I would say it's definitely a social science. I think there's the benefit of bringing some of the rigor from natural sciences when it comes to devising experiments or when it comes to handling the data, but it's not going to be physics.
Got it. All right. So you get your degree, and where do you go from there? Do you go back to with Stan, or do you go do something else?
I mean, then with Stan, we literally had the mirror side of that conversation I had with the Harvard people, which was when I was leaving, he was like, look, just don't expect that you'll just be able to come back here. And so I give him a call when I'm finishing, and he says, great, you can actually come back. But I think he wanted to test how badly I really wanted it. And so I walked away getting paid, let's say X, as a sort of a freshly minted college graduate. And then with a PhD, he purposely gives me something that was more like half X, just to see how badly I really wanted to come back. And so I was like, look, this is not really what I care about the most. I thought that this is the experience I really wanted. So I came back, and it was, really the most amazing 5 years that I'd spent in investing.
So I'd love to kind of pick your brain in terms of what you learned there, and let's start with what were the biggest surprises when you went there and started to learn, not just the theoretical stuff, but in the real world, how investing works.
I think one of the things that I realized that when you come into investing, especially from a grad school program, you are to an extent conditioned to think about the world in a large number of variables. You want to examine every possible angle. You're really just you approach everything like you would a thesis, like you're just trying to do the background research, understand everything about your field so that you can then be at the frontier and discover something new. What Stan made me appreciate was the importance of context, which was one, meaning things are rarely completely new. Something like this has happened before. So having experience and studying history is always very relevant when you're trying to then anticipate what could happen next. And then 2, I would say is almost like this, like Occam's razor principle, which is don't try to study every single thing about a security. Just focus on what you think at that moment in time is the most likely driver of that. And that proved to be an incredibly fruitful approach that I think it's not like he said he invented it. It was something that I think he himself would say was really just passing on, and he had learned himself, but it proved to be a very interesting way of looking at the world, and to a large extent, a big driver of how we develop Toggle.
Okay. If you don't mind, I'm a little bit of a Stan fan. I think he's actually the greatest investor that's ever lived. So I'm just going to get a couple more questions in on Stan before we go on to your career. What do you think is his strength that makes him so unique and just in that upper echelon of trading / investing?
It's a good question. I probably can't fairly distill it down to something that would lend itself to an easy answer, but I'll give you an example of something that I think is certainly an important ingredient of that success, which is sort of strong opinions weakly held, if that makes sense.
Yep.
Like really finding something, having the patience to wait for something where you then develop a strong opinion on it, but always have the ability to change when something on the ground or something just isn't really going the way it's supposed to go, which I think generally translated into holding quite large positions across a few of the theses, but ultimately being able to switch and not just getting out of it, literally reversing. I mean, this is something he can tell you about his dot-com bubble experience, where he went from losing money midway through the year because he was short, then going long literally when the market peaked in March of 2000, and then going back short and ended up making money on the year. So I think it takes a lot of confidence in your own framework to be able to make that mental switch and then make the switch back to your original thesis and end up coming out ahead. Like, I just can't imagine. It's really hard to imagine a trader that's able to do that.
Yeah, the emotional kind of, I guess, strength or even just kind of ability to believe you can make it back and to not get shaken is just shocking. And I guess that he learned from, or he didn't learn, he worked with Soros, and from what I understand, he was very much similar.
So the way I think what people would often describe him as, which I think is correct, is that he definitely had just an incredible, and I'm talking about Stan, not about George, because I never worked with George, but he had just an incredible risk management framework. So again, really patiently waiting for things so that he felt like the odds were strongly in his favor, and also being able to make sure that it never pulled him into a situation that he couldn't get out of.
Got it. All right. So you're with Stan for 5 years. You get a great learning, probably at the best seat in the world. What do you do from there?
Then subsequent to that, I actually ended up going to Fortress, and I was running a global macro portfolio there, alongside Mike Novogratz, who was running the public market side of Fortress. That was also a really, really good experience. I mean, it was effectively a way to understand a very different investing style, which tended to be more short term, more trading oriented, much more active than Stan. So it kind of gave me an appreciation of both the medium term and the short term horizon, in the sense of how to approach investing when you have a thesis and you're willing to stick with it for months, versus how do you try to potentially not hold a position for longer than maybe 1 or 2 days and really follow the kind of almost the pulse of the market. Like, you're really trying to divine some of these daily sentiment changes that the market goes through. I mean, I think ultimately, for me personally, Stan's style was a lot closer. But I think this was an interesting way to appreciate the different types of investors that exist in the market, because I think it gave you, I think when you're investing in a market, it's a little bit like what they say about playing poker, is that you're really playing the person across from you. And I think it's very important in a market to also understand the market participants, because sure, you can look at things like valuation, you have some underlying fundamental forces. Those are going to be presumably the kind of the tide that, moves the water up and down a large amount. But like, there are all these eddies and ripples and so on, and those are caused often by those deviations, I think, are caused by the differing market participants, because there are some people who are going to take a 3% move and basically say, oh, that's for me to take profit, and others who are going to say, oh, great, the move is finally starting. It's time for me to get in.
Right.
And
so was it that dramatic a difference in timeframes?
It was quite dramatic. I mean, I think the background for Fortress was really what you would say kind of Goldman prop trading desk. Like that was the sort of the background there. And I think it and they did it extremely well. I mean, they really were in that kind of strategy. It was a marvel to watch the discipline that required, but it was just a completely different. It was just a completely different way of looking at the market. You would still think about the larger trends that were underpinning it, but you would profit from much smaller moves.
Would you be providing liquidity, or would it be more kind of going with things? Meaning, like, would somebody, you see that there's, let's say, part of the curve is for sale because PIMCO's in there and they've been selling it for 2 days, and you go, okay, now this is the point where I'm going to buy it, or a stock is getting printed into the hole and you guys are going to buy it, punch, and that's providing liquidity? Or would it be the opposite? You'd see, like, you'd wait for everyone to kind of be over their skis too far one way, and then all of a sudden it starts to go that way and you push it along?
Probably more the former. Like if you felt like you understood why the dislocation was happening and you had a strong thesis on why it should be going the other way, so that this is a temporary dislocation, yeah, you'd be a liquidity provider.
Okay. So from there, you're there for a few more years, I guess, and then eventually you end up at, is it a Swiss bank?
Yeah. So then, actually, along with my Toggle co-founder, we basically joined forces. He and I go a long way back, but we ended up working together at Lombard-Odier, which is I think the fourth largest Swiss private bank. And they also had a large asset management group, and they wanted to put together a macro effort because they felt like it would serve their clients very well. They also really wanted to develop that muscle. And so he and I developed that franchise over there. And that was also an extremely, extremely good experience that both allowed us to apply some of the skills we had learned. My co-founder came from Brevin Howard, so he had been also well versed in global macro, but particularly fixed income. And we also got to know a lot of the wealth management private banking side, which is particularly relevant for the things that we ultimately ended up building at Toggle, because the goal here really was to sort of expand the infrastructure to an audience that would go beyond just asset managers and hedge funds in particular. So it was a really good experience.
Okay, so then you've mentioned your co-founder. What's his name, and when did you meet him?
So his name is Giuseppe, and he is, as the name suggests, originally from Italy. And we met whilst he was still at Brevin Howard, and I was working for Fortress in London. And so we really just ended up connecting because we were both interested in A, investing, and B, technology. So even back then, we were tossing around a lot of ideas about how you could improve the investing infrastructure, even started discussing some early prototypes and so on, which actually led to us joining Lombard with a specific idea of building that infrastructure, which ultimately became Toggle during the time there. But yeah, that was kind of his engineering background made him really kind of the ideal counterpart to my more economics finance background. And so we were able to start thinking about a framework, not just in terms of economic models, but also how we could potentially codify some of these things and turn them into what initially would be a Python-based platform, and then eventually grew into more of a, where we kind of are today.
Okay, so I was going to actually ask you, are either one of you programmers, or this is just kind of you have the dream and then you hire the programmers?
I mean, neither of us are what I would say computer engineers, but both of us had done enough programming to be able to give this a start. We did have I think we had an interesting combination of both finance and investing domain expertise and enough coding background to kind of get things started. Giuseppe in particular, much more so than me. But then,
So the first version of the code you guys wrote?
Oh yeah, 100%.
Oh, okay.
Actually, I mean, this was really all mostly Giuseppe writing it down. He and I would whiteboard. He would then turn it into code. He already had started writing before we joined Lombard, and so by the time we left, we actually did have a fully fledged prototype. Which then, of course, the moment the first computer engineer saw it, was like, "What is this garbage?" But conceptually, it was all there.
All right. So why don't we tell people what it is? You leave this and you guys start off Toggle.AI. Give us the whole spiel. Tell us what it's about and like why you felt such a burning desire, a need to do this.
Okay, let me then just take you back for a second to the start of this interview where, you were asking me what are some of the things that surprised me when I joined Stan. And the two things that I mentioned were the importance of context and the importance on focusing only on things that matter. And the second sounds kind of glib, but what that really means is that you really want to narrow your focus on the subset of variables that at any one time you think are most likely to actually really be driving the asset price that you care about. And by this, I mean, I'll give you an example so I don't keep it too high level. Let's say you're thinking about a currency, and for most currencies on any given day, the statistics on the current account really don't matter. Like people just don't care, don't even know what it is. Other than the economist who's tasked with following the country, nobody could tell you what the current account imbalance is at any one time. At some point, it gets far enough out of balance that people start worrying that this country isn't going to be able to really make the payments for whatever imports it's creating. And so at that stage, you get to a situation where all that matters and all that anybody talks about is the changes in the current account. And so taking this as an example, if you can translate this to any asset, understanding whether or not a particular stock or a particular currency, what is basically moving it? Is it the fact that they were, the first into AI, for example, excitement about Microsoft and their leadership in AI? Is it the fact that, their cloud business is growing really fast, which was the case with Amazon for a while when people realized that actually, look, this is not just a retail store. It's an amazing, amazing tech business that was first into a very, very very exciting, and fast growing business. Those are the things that you're trying to get at. The problem with getting into this, and you'll see how the context and the variables combine, is that we are just inundated with data. And so being able to really ascertain what are the things that you should be spending your time thinking about is actually a very hard problem for a discretionary investor. There are so many things vying for your attention, right? There's something like 17 news headlines per second on the Bloomberg terminal. Like it's virtually impossible for a human to be able to just process even just the news, let alone all the data changes, market conditions, and so on. So we wanted to design a system that would just help at the very basic level an investor or a wealth advisor do a better job at extracting value from all this data. Because one thing that computers are really good at is handling large amounts of data. So think of Toggle as being a kind of an intelligent data analytics platform that really takes an enormous funnel of very disparate data sources and then distills it down into just a small number of very likely drivers for any specific asset. And so that's the point about narrowing the drivers. And the context is important because the way it's able to narrow that down into what it thinks are currently most important things for a particular stock. For example, for Amazon, it might be that analysts are turning overly, and I'm making this up, by the way, this is not actually the current situation. Let's say analysts are turning overly bearish on the outlook. And so the system might say, hey, this is something worth looking at because historically, whenever they got this bearish, the stock actually was more a buy than a sell. So it's like a bullish impulse for this. The way the system is able to arrive at this conclusion and at a very small number of relevant drivers is that it studies each of these dislocations in the context of history. So all of a sudden, every investor or every advisor is getting the benefit of that kind of, what you might call the STAN framework of contextualizing it with history and trying to distill it down to any stable patterns that might tell you whether or not the impulse for one development is ultimately a positive or a negative influence on the security. Sorry, this was a much longer answer.
No, it's great. I was letting you go because it was so well done. Okay, so you have this kind of, let's just say, front end that helps investors find what, like, those kind of important points, what is really driving the markets. One of the things that I was thinking about as you were telling me this is I was thinking about Renaissance and how Renaissance will go and they don't care, or at least my understanding is they don't care if the relationship makes sense. And meaning they just look for relationships in general. And if they work, they work. And if they don't, they don't. And then there's others who say, no, that's ridiculous just because, like, the amount of potato farming in Idaho is, correlated to the price of, S&P. You shouldn't trade it. I was wondering where you stand on that. Do you have specific relationships that you're looking for across all the different assets and the different data series? Or do you just kind of let the AI just go on and say, find us anything that seems to be working?
So that is a really, really good question, because that is actually the critical difference between a system like ours and a system that obviously Renaissance very profitably built over the years, because they want to be completely arm's length. They want to be able to run the algorithm and not have to meddle. There's no human in the loop after the algorithm itself had been devised and coded. That's exactly the opposite is true with Toggle, because human in the loop is actually a critical ingredient. So the main difference why their system works and why we don't approach it that way is that they do so many trades that they're okay in having a hit rate that would be very difficult to make profitable when you're only making a handful of trades. A lot of investors tend to invest in, maybe 12, 15 things, which from a market diversification point is quite enough to be at least reasonably diversified. But at the same time, you need a reasonably high hit ratio and the upside versus downside risk in order to turn that into a profitable investing strategy. The way we approach this is we will highlight sometimes relationships that are based only on maybe 7 or 8 past episodes. That is not nearly enough to build a trading signal framework, right? You need thousands of these in order to say, okay, great, on the basis of this, I'm content to just close my eyes and let the system trade. But it also means that it has to have inherently an economic relationship. And so the driver of everything that we highlight is a knowledge graph that is, I would describe it as our best up-to-date understanding of all of the investing relationships that could potentially matter for a particular security. And so, we'll say, oh, actually, the yield curve probably matters for banks. The yield curve in the US matters for Australian stocks, but the Australian yield curve does not matter for US stocks. So there's an element of kind of restricting what the system can surface because we impose this condition that there has to be an economic relationship, if that makes sense.
Yeah, completely get it. So you're not trying to get rid of the humans, you're just trying to make them better with some AI.
We're basically trying to make it easier for somebody who's trying to think about let me take a step back. What I think humans are really good at is basically thinking creatively and thinking outside of the box. What computers are really good at is basically taking that thesis and saying, hey, you know what you think is the first time happening, I actually think has happened 8 times before. Here's what happened 7 out of those 8 times. If you still think that, something totally different is going to happen than what has happened 7 out of 8 times before, it's going to force you to be much more rigorous about thinking about the downside and the upside. And it's going to give you at least a baseline for considering how the market is likely positioned, what the upside is versus the downside, and so on. And so it creates a very good, I think it's very complementary to kind of have this combination. And ultimately, you almost have, I don't know, you've probably seen the Iron Man movies. It's like you're Jarvis. You can still be the mad scientist, but you have somebody in the background who's just running numbers really quickly.
Right. You know, while you're telling me that and talking about the 7 out of 8 times, right now the market yesterday had an outside reversal in the S&P and everyone got real bearish and talked about how awful this is. And then when you actually go through the numbers and you look at it, what's happened in prior outside reversals, it's actually not that bearish. And it's funny how many things are like that in the markets, that you have something that is treated as like, oh, this is the way it is. And then when you actually go look at the numbers, it's not that way at all.
And so you came up with the perfect example, because that's exactly what Toggle is meant to help you with, right? It recalibrates your expectations a little bit. You think, oh, wow, consensus is this is really bearish. The system says, okay, well, fine. You think it's very bearish. Let's just take a look at the last 37 reversals. How many of them resulted in the market going down? Let's say it turns out that actually only about 17 of them ended up with a bearish outcome. It's really going to change. And maybe it's even the majority. Let's say it's 20, right? But 20 versus 17 is still something that you might think, I really don't want to bet the farm on this.
Right. Yeah. Do you have examples of things that it's telling you now that it's interesting that we can talk about?
Well, so since you're actually talking about bearish, it's interesting. One of the things that we do, because Toggle analyzes about 40,000 assets, and it does what I think can best be described as like a health check, right? So it takes Apple and says, okay, what changes are there in analyst expectations? What changes are there in trading volume today? What changes are there in the macroeconomic conditions? What news is there around Apple that could be impactful? Every day this happens. Sometimes one of these variables has a big enough move that the system says, oh, let me just check the history on this and see if this could on the margin be positive or negative. The reason why I'm calling this a health check is if you and I went to the doctor every day, they'll take all the vitals, then maybe one day you come in and you're like, oh, your blood pressure is a little bit higher. It doesn't mean you're going to die the next day, right? But they'll say like, hey, well, you know what? We're just going to monitor this a little bit and see what happens. Just a red flag, basically. So as we do this, we are able to construct a kind of an interesting market breadth indicator, because we can see whether or not across most of the assets we look at, are any of those insights that the system is uncovering predominantly bearish or bullish. And most days they're, across the market, it's kind of neutralish. But at the moment, quite a lot of them are bearish, which doesn't mean that the market is necessarily, that the rally is over, but it certainly often implies at least a correction or like a longer period of consolidation, if that makes sense. So that's maybe
when did that sprout up? Is that something that just happened this week or yesterday, or when did it come?
It sort of started signaling this, I'd say maybe like a week or 10 days ago or so. Like it happens incrementally every day. The system will kind of raise a flag and say like, hey, by the way, today, again, we have more negatives than positives. And so it's been signaling this for a little while.
Right. Now, I listened to another one of your podcasts that you gave, and you talked about your 3 different phases of Toggle. I'd love for you to go through kind of what you have, your dreams for it, and where we are in terms of which phase we're at now.
I mean, I think, for the last, I'd say 2.5 years, we were kind of in the phase of really just actually building the platform. I think it was more about building and less about introducing it. We stress tested it, obviously, but it was really the tech phase. Then I would say the last year or so, it was offering it to the people that we knew best and that were closest to what Giuseppe and I were doing previously, which is hedge funds and so on. So we now have a number of hedge funds ranging from, Viking, Diamond, Millennium, Exodus Point, and so on as clients. I think this is still the phase that we're in. We're kind of expanding that client base. But I think with the developments that we're now seeing in the large language models, it's opening this up to an entirely new audience, which I would call is more wealth management and asset management. So people that aren't necessarily directly managing a portfolio, but are having to advise on it, and often also don't have the infrastructure to kind of translate day-to-day market movements into specific insights that their clients can act on. The reason why I'm tying this to the Gen AI moment and large language models is that since we've always been system driven, meaning that the machine was doing all of the analysis, from very early on, we used large language models to articulate those insights. Now, you can think of this as almost being like a Rosetta Stone moment, because what in my mind is the single biggest step forward in this AI technology is that machines are able to understand us as well. We were able to understand them because they could use these models to articulate what they had found, but you can now ask a follow-up question, which is amazing. Like, you're able to control all of Toggle by literally just formulating your question, and the system says, got you. You're basically just looking for a summary of a research paper that JP Morgan recently published. Here it is. On the other hand, you're actually looking for a little bit of a deeper analysis here. So let me go find the right data, find the right analytical tool. I'm going to run this analysis for you, and I'm going to then present you with the results, both the quantitative side and the qualitative side. That, I think, is a watershed moment for somebody's ability to use a very sophisticated analytical system without really any learning curve. It's like taking an incredibly fast sports car that was previously only available in stick shift, and you've just built it with an automatic.
I was going to actually ask you if you welcomed or were upset about the recent kind of hoopla about AI and all this kind of popularity, but I guess that's a resounding you welcome all these new kind of advancements.
I think it's a very popular word that everybody is using and abusing, and we're certainly guilty of it, is this democratization, leveling the playing field, and so on. Like, everybody wants to do that. But I think here, genuinely, you've now given a lot of people the gift of communicating with the machine, which is why I'm calling it the Rosetta Stone moment, because you're really finding that those who have always wanted to go back to the data to test certain things were just intimidated when you told them, well, okay, great, just build a macro in the Excel spreadsheet, or here's some statistical software like Stata, just write a little script and it's going to run that for you. And they were like, I don't know how to run a script. No. And so you go with an instinct instead, or some sort of like a lame rule of thumb. Whereas now you literally can go to the data.
The other things you mentioned is that you're going to talk about portfolio development and then analyzing your trading style. Are those things still on the drawing board?
Yes. So in terms of the skill sets, the next thing that a system can do. So currently the focus has been on analyzing assets and analyzing the drivers behind those assets. The next one is taking that to the level of a portfolio so that we can say, like, hey, by the way, your portfolio acts this way or that way under these conditions, and here are the assets most responsible for it. This is something that's particularly relevant for portfolio managers or wealth advisors. And I think then the third one is going to be a kind of a behavioral, almost like a trading coach, right? Somebody who's saying, okay, Jan, I mean, you're buying in what you think is a sell-off again. Just want to tell you that you're always too early. Like, every time when you buy this stuff, 5% off, it goes down another 10%. And by the time it's down 9%, you get out and lose money. Like, you're terrible at buying the dips. So you should really stop doing it, because 19 times out of 20, when you've bought the dip, you lost money on it. So right. It can give you that kind of real-time feedback that hopefully, because it's done objectively by a machine and not somebody that you might resent because you think, oh, they're just jealous and saying this for some ulterior motive, you might take it seriously and act on it. And they'll present you with actual numbers.
Or you'll just resent the machine too.
Maybe you'll resent the machine. That's true. I mean, people have started developing emotional attachments to machines too.
Oh, Jan, I could talk about this forever, but unfortunately we're getting towards the end. So we're going to end with our questions. Let's start with your favorite investment book.
So I actually, the one that has made the most impact on me and was actually a recommendation from Stan was Reminiscences of a Stock Operator, which I assume you're familiar with, but
Oh, yeah.
was for me a very interesting book because it seemed like it painted such a visceral picture of the market and the prices and the ticker. Like you felt like you could literally smell the like the trading floor and the sort of, you know, every little tick up or down in the stocks. And I think it was a good reminder that behind everything we do, behind all the hard analytics, there are basically people making decisions. Sure, there are machines making decisions as well, but there are basically people and emotions that are involved. And it's a very complex process.
Yeah, it's a great book. Oh, next question. Are great traders born or made?
I would definitely strongly say that they're made. And I think so because you can see that there are certain things that people are able to learn. I think you remember probably the sort of like the turtle trader experiment where they gave them a certain framework and I think they had quite a lot of success with that. And secondly, I think even though people who are good traders have come from a lot of different backgrounds, it seems like the things that a lot of them have in common that often was kind of bred through the experience is curiosity and a very strong decision framework. And those don't seem to me like you just need to be born with them. I think you can acquire them.
Oh, that's a great insight. All right. Byron Wien used to do his top surprises for next year. He defined a surprise as something the market has assigned a less than 1/3 chance of happening, but he thinks there's a greater than 50-50 chance. Do you have a Byron Wien surprise for the next year?
So I will say that a surprise, I'll give you two surprises. I think one of them is that next year when we have the presidential election, I think the president won't be named Trump, Biden, or DeSantis.
Wow.
So that would be my first one. And then the second one is that I think there is definitely a much larger, certainly much larger than a third, but I guess the definition is needs to be more than 50% probability that there actually ends up being a recession next year.
Okay. And what advice would you give a young person starting in this business?
I would say, and this is despite the fact that I've strove very hard in the other direction, that time and focus will trump intelligence and education in what is going to be ultimately responsible for your success.
I got it. All right. Now we're going to try something new, and you have the honor of being the first one. I was listening to a podcast that was completely unrelated to finance, but they had this great kind of tradition of asking the guest to leave a question for the next guest. So we don't have a guest, because you're the first, we don't have a question from you from the previous guest, but you're going to leave a question for the next guest. What would you like to ask?
So I'll give you two, and you can then decide which one you think is more applicable, since I don't know who your guest is going to be. But the first one is more serious. The second one is a little bit more fun.
Okay.
The first one is there any ingredient you used to believe was essential for success, professionally or personally, that you no longer think is crucial at all? So like something that you've changed your mind on, something that people told you was absolutely critical, and now you think it's not important at all.
That's a great question.
And then the second one, which is a little bit more fun, is like if you had to eat the same meal for the rest of your life, what would that be?
I'm asking both, Jan. I'm asking both. Those are great questions. Thank you very much for that. Now, before you go, why don't you tell everyone where they can find Toggle? I'm assuming it's Toggle.AI, and just give them the whole kind of 9 yards.
So yeah, I would invite everybody to try it. It's Toggle.AI. You can sign up very easily. Try it, test drive it. Also contact us with any questions. But anybody who's remotely interested in following markets is able to try it completely free, and actually also use some tier of it completely free. And we hope that for no matter what your level of experience is, it just gets you to think a little bit harder about a more rigorous framework of assessing and following the market through some of the data. And I think there will be something for everybody there.
That's great. Well, Jan, it was a pleasure getting to know you, and thank you very much for your time.
Thank you very much. Really enjoyed being on the show. Thanks for inviting me.
Take care. All right, Patrick, time for talking charts. What do you got for us?
All right. Well, let's start off with talking about the top three things we were watching a few weeks ago. We were watching that U.S. dollar, Kev. And you know what? The weakness persisted. At least the reactions now to the central banks gave at least a slight rebound in the dollar. I wouldn't want to call it a rally, but simply just off of its worst levels in the post central bank kind of window. But overall, the dollar still remains relatively weak. It'll be interesting to see whether the Dixie can get above the 102 level in the coming week. Any thoughts before we move on?
Actually, Patrick, for the first time, I actually think that the currencies aren't going to move as one against the US dollar. I think you're going to increasingly see divergence between the euro and the yen. And I think that this kind of talking about the dollar in general, like across the board, will be replaced with more of us talking about
thematically some of the individual ones, right?
Yeah.
So number two was we were watching the earnings, and well, overall, I think we have to really talk about this more even in a week after we see Apple and Amazon and a few of the other ones come out. But, it's been a relative mixed bag. I mean, there's been a couple clear beats and a couple of the big behemoths like the Googles and Metas that have worked higher. But there's also
I would take the other side of that, Patrick.
But there's been a number of misses.
Better than a mixed bag. There's always some misses. On the whole, the market's kind of grinding higher, though. It feels to me like the earnings were people were expecting a dip, and it still hasn't come.
Right. And number one, we were watching, obviously, the central bank statements as we had both the FOMC, ECB, and then the Bank of Japan. You were talking about the Bank of Japan being the one to watch. They did adjust the yield curve a little bit. Any thoughts on what we saw in the last 48 hours?
It was a little bit of a nothing burger when they finally did it, though, because we did have that move on Thursday. What was it, at 1 o'clock in the afternoon? The Bank of Japan leaked through the Nikkei news organization that they were considering doing altering the YCC, or at least talking about it. It was interesting because, first of all, that's 1 a.m. in Japan time. I didn't really understand why it was coming then. And yet the stock market in the US took it so badly. It was just a brutal selling, and maybe it was just one of those situations where we needed an excuse, and this was the excuse. And then they actually go ahead, they do it, they tweak the YCC. You'd think that we might get a Japanese yen rally, maybe we get a risk-off continuation, and instead it's just the opposite. Stocks in the U.S. scream higher, yen goes down, actually. It's kind of just weird summer action, I would say.
Well, listen, I want to get to the charts and we'll look at all that stuff in a moment, but let's quickly go through the top three things to watch in the coming 2 weeks. Not this coming week, but the week after, we have the inflation numbers coming out. Obviously, there's a lot of the kind of hawks toward inflation that are looking for this to start upticking at some point. What are your thoughts on inflation here?
Well, I do think that they're right to be in this top three things to watch. If you listen to Powell's conference, he highlighted numerous times that there would be 2 inflation numbers, 2 employment numbers, and 1 ECI before the next kind of meeting. And he said, once they see all those, then they will make their decision. So he's obviously, and the committee, they're obviously watching this very closely. I'm expecting, an uptick in terms of inflation. I think that we bottomed last month. Having said that, we have to be aware that there's a lot of volatility in these, and I worry though that the market's gotten a little too complacent about expecting inflation to continue its downward trend. And if you actually look in terms of what the inflation swaps are pricing in, it is actually an expected uptick now. Whether the number ends up beating or being below expectations I'm not sure.
It's a thing to watch. That's certainly something that's going to be on my radar. Number two, this coming week, we have the ISM in the U.S., both the manufacturing and services, and obviously just looking to see whether or not they show further weakness or whether or not we see that little bit of a rebound in there. Any thoughts on that?
I don't know, Patrick.
Okay.
It feels another. I think it is important to watch. A lot of people are expecting the economy to roll over. It just keeps surprising. I think recently we had some numbers that one of the things that was kind of shocking was in the past we had seen services upticking, beating expectations, and manufacturing downticking expectations. And in fact, this last time was the opposite.
Mm-hmm.
Manufacturing upticked and services downticked in terms of versus.
But services are so much more important, right? Because it's just a much bigger part of the economy. And that's going to be the one I think that would be the more likely of the two to be the market mover. But the number one thing to watch, though, Kev, next week has to be the jobs numbers. Like you said, Powell stated what he's looking for. But you know what's the thing to me? I am starting to believe that the jobs numbers could just keep holding in there until some real economic recession inevitably emerges, and it will probably be already in the midst of the recession by the time you see them upticking. I don't see them being a leading indicator, so to me, I wouldn't be shocked. Like we had. I heard the interview with Darius Dale, and he was talking fourth quarter or first quarter recession risks. Who knows? Maybe the jobs numbers stick in there for even 3, 4, 5 months before we see them even start to uptick. It'll be interesting to see what the number comes in at.
Well, there's no doubt that the unemployment numbers are a backward-looking number. Having said that, they still need to uptick a little bit before you can get bearish about the economy at all. And in fact, everything else is looking great. So I don't know. There's been a lot of economic numbers that have been going and doing things that people haven't expected. That's the one thing I would say about this kind of move out of the COVID period is that all the things that we've traditionally accepted as this, this indicator does this before this one does this. A lot of those things have been just completely thrown out the window. And I go back to Dario Perkins. He says that everyone was expecting this to be a regular cycle, and it's been anything but a regular cycle.
There you go. All right, so let's hit some charts. All right, so S&P 500, you talked about that reversal yesterday in the overnight market when that news hit out in Japan. But you can see today the market just completely bullishly reversed that, got right back up to the highs. We're right at this 4,600 level. But, when you step back and look at that weekly chart, what's really at this point technically stopping this market from just doing a full-on retest of all-time highs? Like, if this market was going to reject at a fib zone back at 4,300, that would have been that kind of stress point. But now that we've made it this far, it's hard to, argue that 4,600 is going to be where the high comes in. I obviously remain skeptical of, the market being at these levels in the first place, but that doesn't mean they can't go higher first. And one of the things that we look at from price action is like, look at that. The sell-off happened yesterday, and the buyers came in right away, bought the dip. That's a characteristic of still accumulation, and that the bulls still have a little bit of gas in the tank, money on the sideline. This, without there being some spark that starts the real sell cycle that begins some sort of a correction, then you have to assume that the prevailing trend that's been in place can continue. And at this moment, a move towards 4,700 and maybe even 4,800 wouldn't be a shocker to me.
I think back to remember those times at the beginning of the year when I said that we can't take a 1987 style year off the table.
Yeah, I remember that.
And look at what's happening.
Yeah, dude, you were bang on. I was obviously
I was
far more
long enough. Though.
Well, yeah, but I was far more concerned than you were and skeptical. But it certainly has been the case. It'll be interesting to see how much this market can hold up along here. But look. If there isn't an immediate reason for this market to sell, something that just blindsides it, kicks the feet out from underneath it, it just isn't going to turn on a dime. And at this moment, you have to derail this entire rally. And just as a little kind of noteworthy point, we're 200 points pretty much above the 50-day moving average. I'm obviously rounding. We're like, that's just a basic arbiter of trend. And we would basically need to sell off 200 points just to be testing the 50-day moving average. The point is that there has to be some serious technical damage to dent this prevailing uptrend, and this is where at some point the rally will be checked. But it probably will take months to top this market out before a really deeper, more meaningful sell-off can ensue. Inevitably, I think one will happen, but I just don't think it's going to just, turn on a dime and, the second week of August, we're already down at 4,300 or something.
Well, and the other thing, you mentioned August, it's just getting more and more thin out there in terms of the trading, and less people are manning their turrets, and it's just kind of an empty canyon. And I tend to agree that if we're going to see any real selling by portfolio managers, they're not going to give the orders for a middle of the summer, get me out of my stocks. So absent anything in terms of new information, I suspect that all we're going to do is at the very minimum, just chop around, and then maybe we just keep grinding higher.
I think that would be a typical thing to see, which is you'll see that the bulls are losing their momentum. That kind of upside momentum that they had starts to dissipate, and rallies are immediately met with selling. They lack follow through on the upside, and this is where technicians will start throwing things like, double tops, head and shoulders patterns. They'll start looking for topping formations, rounding tops, and all these different things to start putting that in. There's nothing like that right now. Right now, the primary uptrend is still in place, and by Monday we might be making a fresh high, and that 1 day dip was just a pause in what has been a clean uptrend. We'll see how it plays out.
I still contend that we're going to broaden out, and I wouldn't want to own the Mag 7 up here, but I sure don't mind owning like a Russell S&P equal weight or even a small cap fund.
Interesting that you say that. So the equal weight S&P is doing a direct test of its January, February highs. Came in with a bearish engulfing candle right along the highs. Interesting kind of resistance point on the equal weight. At the same time, the Russell is doing a direct test of 2,000, which is where its January, February highs came in as well. And so we're actually at a pretty significant technical level on those indices you just mentioned, right? The small caps and equal weights. I think it would be significant if they, in the coming weeks, were able to beat these highs and make another impulse higher, because then that really opens the window for some of that rotation to that you're talking about to actually happen.
Patrick, when you zoomed out there, I noticed that there's it's not just a double top.
Oh, no, but I don't like that. You know what? Triple tops should only ever occur at tops. This is a resistance point at a bottoming formation. I don't think you can do that, bud. You have to look at this. You can look at this, and these are bottoms, not tops. Like this is multiple tests of no such thing as quadruple bottom here.
Some people like to look at bottoms, others like to look at tops. That's just the way it goes.
All right. Anyway, so listen, dollar. My level to watch is this level we're trading at right now, this 102. And while it did get a little bit of a boost in the after the Bank of Japan, to me, we were so oversold that we got just a typical 50% retracement. And what typically happens is that what were major supports act as overhead resistance. And so it'll be interesting to see whether the dollar can beat 102. If it gets above 102, we enter back into the trade range chop. And then the short-term sell cycle may subside. But if it reverses here, and we're, let's say, at 100 by middle of next week, there could be another full-on sell cycle. It'll be interesting because let's go through some of the individual currencies. Look at the euro pulling back again. Almost, it's obviously the reciprocal, which is all of the previous highs act as support. Pull back right into a retracement zone. Will 109, 110 hold this pullback and see the euro work its way back up to those highs? You look at the pound sterling.
Can I jump in here on the euro?
Yeah, go for it.
Before you go on to the next one?
Yeah.
I'm getting bearish. And you know me, I'm generally not one to be bearish this thing. I feel like there's a decent chance that euro's lower in the coming months.
So where I would jump on your bandwagon would be if we, let's say, had 109 given out. So let's just say you had a breakdown down to its previous lows from earlier in the year, and then a failed rally. And then you can, then technicians will start seeing things like head and shoulder patterns and other things that mark the top of this entire advance in the euro. But I think it's way early to be getting bearish yet. I mean, if right now the bulls turn this around early next week and we're back to 111, 112, it's just too early. Like, this is why the support here is so important.
This is why, Patrick, what else is new? I'm always early.
Mm-hmm.
And I was just looking, by the way, I was looking at the DBMF, which is that Andrew Beer's great product where he replicates the positions that the CTAs have.
Yeah.
And it's actually shocking to me. They're all long euro, short yen. And I get it. When you pull up the euro yen, I know they didn't do it as a trade like this. They didn't go and buy euro yen. But if you look at the euro yen cross rate, it has just been a steady uptrend.
Yeah.
And I think that's, I don't know. To me, that feels like that has a potential of topping, and ultimately, that's what I'm bearish euro, but I'm really bearish euro yen.
To me, like, I have a hard time, because everyone wants to be bearish the U.S. dollar. That it's the U.S. dollar's losing its place as the world reserve currency. Blah blah blah. You have all of these different things, but to be bearish the U.S. dollar, you have to make a case as to why the eurozone can sustain a much stronger currency. And while I'm not saying it can't, I'm just not, I don't think that we're heading to 120 or 125 on the euro. I think that obviously was incredibly oversold, and so we had a 1 year rally, and I mean we're now, we went from basically almost parity to 130. Right? Like, it's...
What do you mean parity to 130?
Well, if you... Oh, sorry. Oh, my God. I'm looking at...
Yeah, you're looking at the...
Oh, my God. No. But, well, we were under parity. Like... Oh, sorry. 112. Parity, sorry. Yeah, I was looking at... My apologies. I was looking at the pound sterling. Right. But yeah, like, it's already had a 1 year rally of, off like 96 cents to like 112, right? But the pound sterling, that's another one. Like, it was down at 104, 105, headed to 130. We've already had these extraordinary counter trend rallies in these currencies. It's not that they can't continue, but I mean, you have to think that these are seventh, eighth inning moves where the big move has already happened.
Well, that's why I like the selling euro yen.
Yeah, but here's the U.S. dollar yen. What's your call here? You think that the U.S. dollar strengthens here, or weakens against the yen?
No, I think it weakens against the yen. I think that this thing goes down to 130. Japan is so cheap, like, it's just dirt cheap, and they're doing everything right. Capital's going to be flooding in there. They're finally letting up in terms of the YCC. Everything's in place.
When you look at this chart, I don't think it agrees with you, bud.
Yeah. Well, what else is new? Everyone knows. You know what? I had the funniest subscriber the other day say something like he was joking about how he should wait 1 or 2 weeks before doing something after I, say what I'm doing. And he says, sounds like you already did a little bit of self-control, or like already waited a little bit in there, so this might not apply this time. because I said I've been sitting here waiting and waiting and waiting for this trade to come, whatever it was. And he's like, he sounds like I don't have to apply this because you're not that you actually showed some self-discipline.
There you go. Anyway, I wanted to touch on the asset that shall not be named.
Oh, come on, really?
Listen, I want to technically observe it. Can I just make that observation?
Sure.
Okay. So overall, it has been exhibiting the characteristics of higher lows and higher highs. And this entire pause over the last several weeks generally is still fits the bill of the same patterns we've been seeing over and over again all year. To me, this level right here, this 28 to 29,000 level, is going to be a really important fib zone to watch, because if there is a continuation pattern that sends Bitcoin back to 33 to 35,000 on the upside, it's got to hold the line here. The support line's got to hold in this zone, because if Bitcoin breaks down to 25,000, it's done. And like that, the tops are in, and so all I want to say is that the bulls better show up here, and if they do, then they've got a good run for at least 3,000 to 5,000 points on the upside. But
you told me that was all you wanted to say.
Yeah. All right. So next, let's move on to gold. I have here the December contract, because the continuous contracted the roll to the December one, so it looks like a gap, but it's not. Just the contract roll. So the December contract is at 1999.9. Right at the
great song.
But we're gold. Is it gonna go or not? Like, this is, like, to me, gold really has done nothing wrong, but is just dragging its heels. Like, when you look at silver, the chart on silver just looks so much better.
But
like,
to be fair to silver, it's trading better. It's felt like it's got a little more
Yeah.
stick in it, and like a lot of days you'll sit there and you'll be like, oh, silver's got a bid. Gold's kind of, sucking wind or not doing anything.
So the question is silver leading gold, or is silver just going to do its own thing? Because like gold miners don't seem to be giving a shit.
Listen, it's a huge disappointment, the precious metal square in general. I would say that the fact that silver's got a bid is a good thing.
Yeah.
I'm not going to get fussed about it. I'm happy with any of them going up. And I'm not gonna read too much into it. I still contend that given the fact that interest rates have risen so much, and real rates especially, like you go look at 2-year real rates, they recently broke out to new highs. 5 years are doing badly. I think gold's hanging in there remarkably well. So whereas some people will be disappointed that it's not up more, I'm happy it's not down more, given what real rates are doing.
There you go. So let's talk crude oil, though. Boy, has it improved. So using the traditional technical analysis stuff, that things like moving average crossovers, MACDs, all these types of things, crude oil is now giving buy signals and bull signals right across the board. Now, what I was looking for was it to just get back into the first quarter of the year trade range, which we are now at the top of that trade range. The $80, $82 area more or less is contained almost all of the tops for the year. So typically when you approach highs like that, the rally will get checked. And so at some point it bumps its head, it takes a couple of days off and does a little bit of mean reversion. But what I'm dying to find out, and from the price action of the tape, is to see whether the pattern of buy on dip starts to emerge. At some point there's going to be a pause in this. Will it be bought on dip? Will it show accumulation? If that's the case, do we have a move going back to the fourth quarter highs near $90 in store? It's a chart that is doing a lot of technical repair work. It's starting to look good, and now I want to see whether or not dips start getting bought.
I'm with you, Patrick. I like it. I'm a crude oil bull. I think the curve, in terms of the shape of the curve, has gone from a kind of bearish formation to a bullish formation. Everything's looking good.
What's interesting is that when you take a look just on the RBOB gasoline, that actually has been almost leading the way. It broke out to fresh year high, beat even the fourth quarter highs from last year, and is improving. So I don't know whether that's a summer driving season effect or whatever it is, but gasoline's been leading higher, and that I consider as a good sign for crude oil here.
You know, the other thing, going back to crude oil, I was playing around and I was deflating it by the CPI to get it in constant real dollars, just to get a feel for how much, like how much we've risen or how much we've fallen. And it's kind of shocking because crude oil is actually relatively cheap on the, on those constant dollar basis.
Oh yeah.
Like you think $80 is a big deal, but don't forget, this is like, we've had a lot of inflation. The $80 today is a lot different than $80 in 2005.
Agreed. So let's move on. I wanted to just touch on the price action in uranium. Now, the Sprott physical uranium has been selling at almost a 10% discount to net asset value. It pulled back much deeper than the U308 contract, but it's upticking. But what's really interesting is the uranium stocks continued to hold up very, very well. Like, look at the way Cameco, just every dip gets bought, pushing new highs.
Do you know who gets bought by?
Yes. You know what? Like, it makes me feel dirty. Being long.
Tell me who is behind Cameco.
Kathy, crazy Kathy.
Yeah, Kathy Wood. She's buying it, and it's always like people, the uranium bulls are like, oh, I don't know whether I should be celebrating this or.
But no, you know what? No, listen. Actually, I consider it a huge plus because Kathy can get onto trends and ride them pretty well. What she has the problem is getting out of it. She'll ride it all the way up and then ride it all the way back down. But I don't think it's actually a negative that she's getting into it. I just think it may actually even put it on a lot of people's radars that typically don't go into the resource space.
That's true.
And
right.
so
her buying it might have made it more kind of acceptable for any of the tech / new age thinkers to own it.
Yeah. I
we
think
should probably be thanking Kathy.
So there you go. And so I wanted
make
to
sure you sell her the last little bit of yours.
Yeah.
Like when she's coming for that one and she's just sending it up to the really outrageous price, just make sure you're there to sell it.
Yeah. Just selling it. The one thing I wanted to just touch on is these ag stocks. What's interesting is in the agricultural space, obviously, there's a number of these underlying commodities that have actually been doing very well. Obviously, the ones that have been dragging their heels have been like wheat and corn, even though wheat's been doing half decent ever since the shipments in Ukraine, Russia have become geopolitical. But what's interesting is these ag stocks have been left for dead throughout the early part of the year. And this V-shaped recovery that we've seen in the last 2 months has put them back in action. It'll be really interesting to see whether or not this is a new meaningful trend and whether we're heading right back to the 2022 highs up in the mid-90s. Are you generally playing any of these ag stories?
I'm not. I probably should be, but I'm not in any of those. And I know there's been a lot of action and there's a lot of excitement. But I have really nothing intelligent to say, which is, usually I have something to say. And at this time, I don't even have anything stupid to say.
There you go. Anyway, let's touch on the 10-year yield.
Okay. I definitely have something stupid to say there.
Since you're on the topic of stupid things, let's talk about
right. Let's talk about your 10-year yield position, Kevin.
Yeah, exactly. But it's a pretty consistent weakness in the bond markets. And while I don't hate your thesis, In fact, I over a multi-year span can see a lot of your arguments coming to fruition. Like I'm not a hater on it. I just didn't think it was all. I thought that the 2022 bear market was so devastatingly bad that everything was going to settle down, and especially with things slowing down generally, that there was room for bottoms to be in the bond market, and the highest of the yields, at least for the year, to be in. But boy, does it feel like that thesis is going to get tested that I'm making. Like this thing just is trying to break out. It's already testing 4%. I mean, for it to tack on 25 basis points and make it go at the October highs seems entirely plausible here. Like, are you like uber bearish here?
Yes.
Okay. Let's not gooch it then.
We just had 9% inflation that looks like the economy continues to surprise on the upside. I understand that recession is tomorrow. It's going to happen. They've been telling me this for the last 6-9 months. One of these days they're going to be right. But I just, even if we get it, I question how far the Fed's going to have to lower rates before the economy picks up again.
Yeah.
And then I ask myself, with all the supply coming, with an economy that's stronger than expected, with the problems with China in terms of that relationship breaking down, I just say, like, are bonds really an attractive risk reward? And not only that, sentiment wise, everyone owns them, Patrick. Like, everyone thinks that there's a recession coming or some sort of market event, and they're all hiding in these because that's where everyone made all their money before.
But it's also got you a positive yield, right? Like, I mean, before, when interest rates were near zero, there was no benefit in being bonds, but you could hide and earn yourself a 5% yield.
But Patrick, if you hide in this, and in the meantime,
rates
go from 4 to 5. It's
it's painful.
Your coupons are not going to pay for.
Well, okay, yeah, you're talking long duration ones, but
right.
I don't.
Well,
that's not the case
if
for.
You want to go hide in like 1 month or roll 3-month bills, then I get that. I'm not. It's tough to be bearish that. Like, the reality is that inflation's 3%. 1 year or 1 month bills are 5 or whatever they are. You're earning 2. Like. And if that's what you want, then that's great. And there's lots of optionality in terms of owning that. But in terms of like going out the curve because you're convinced that there's going to be an event and that's going to cause this deflationary collapse, and that you're going to make all sorts of money from being out the curve, I'm going to take the other side.
There you go. Let's touch on the weekly chart on the Euro Stock 50, and I just wanted to let's talk a little bit of equities here for a moment, but that's a breakout of a multi-year high that just happened this week in the Euro stock. The 4,400 was where there was some substantial resistance, and when you really zoom out, I mean, yeah, it tested zones near 45, just over 4,500 back in 2007. But with this breakout, the question here is, are we going to go back and retest some of these multi-decade highs? Is this breakout going to stick here? Interesting that the Euro stock is making this kind of a breakout. And I know that Marco was talking about playing Europe as a China story. You generally inclined to buy European equities still here?
Yeah, I don't want to steal any of Marco's thunder, but I think that a lot of people are questioning whether the Chinese stimulus is as much as they were hoping it was going to be. And they're wondering in terms of what is going on over there in terms of like by the fact that they refuse to stimulate in any sort of meaningful way. Having said that, Patrick, it's actually, if you look at Chinese stocks, European stocks, they're behaving like there's a good stimulus coming and it will be enough.
Yeah.
I don't know.
Look at this reversal in the China A50. Like, what a move. Like, that's after spending the entire year descending in a kind of a consolidation pattern. We now, like, even just if you take a nice thick crayon and just draw that trend line, like that's a pretty clean breakout in China. Now, maybe those worried about the geopolitics could play it with some gamma and buy some options so you don't have to hold the underlying, but it definitely is a breakout.
Yeah, I'm with you. I don't know what to say because I'm not especially bullish. Like it's not like something that I'm excited about owning, but it seems to be going. Like as you always say, you should just do what listen to the charts. Don't put your opinions on it.
Yeah, just two more global equity ones I want to touch on. India has been hot, and it's been working. It's been one of the hottest markets. I'm surprised, that we haven't talked more about it. But this thing's been going, but it's finally paused here. And it's interesting because it doesn't seem to have any global correlation, or at least no evident one, to a lot of the other major global indices. It kind of runs whenever it wants and pulls back whenever it wants. It just marches to the beat of its own drum. It's really interesting to see whether or not a short-term high is here in India and whether it gets bought on dip.
I don't have anything to say except that I was long it. I still like it, but I once it outperforms that much, you kind of have to wonder if it's still the best place to be.
Yeah, and the last one I wanted to touch on was this breakout in Brazil. The Ibovista has kind of made a key breakout, very similar to the kind of breakout we saw, let's say, in the Euro stock, but had a bit of a down day here. I'm very, very curious, and one thing to watch next week is whether or not this gets bought on dip and whether this bull trend can continue. The most disappointing thing is if this prairie dogged, right, where it just gives it all back and it was a false start. Because of the way that it reversed here today, I think it's worth watching to see whether or not the bulls come in there early next week with another and just defend the price action up at these upper zones.
Yeah, I'm with you, Patrick. I think that it is something to watch, but I'm a lot more excited and hopeful about that one than I am about India.
All right. That's all I got, Kev.
All right.
Let's go on. It's time for skin in the game. You got me, but you got me like 2 days into the trade.
I know. It's kind of embarrassing. Well, you know what? Though the really embarrassing part about it is the fact that you believed, what was the bet again? You believed that the September 10-year futures would touch that. You thought you wanted to go that way, but you felt that the option was mispriced, which it was. In hindsight,
I thought you were.
You were. I was ripping you off. I put her in the old calculator and I figured out. And I thought I knew how much you would pay for it. And I gave an offering and the client passed. But unfortunately, I got stuck with the position. But it's one of those cases where the client should have taken it. And you should have taken what you wanted because that's what happened. 2 days later.
Well, look. You know what? It popped for 2 days and then came right back down. It literally just, it was like it one touched right into it and came right back. So it's like unbelievable.
It was funny because it was really quick. Like I think someone emailed me or texted me like within a day and says, Patrick's going to lose his thing like this like tomorrow.
Yeah.
That's right. I didn't want to talk about it or say anything because I didn't want to goocher it. All
right. So listen, explain the game and then it's time for you to make a bet.
Yeah, Skin in the Game is our weekly opportunity to demonstrate that we are degenerate gamblers at heart. Every week, one of us, every second week, every one of us presents a wager and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode. And we've had some real changes in terms of the rules, right? We're only allowed
just the size of the
size has to be 3 points per bet now. Can we know the current score? We're going
36 to 45.
We're going to 50, and they have to be a minimum of 3 every point. And it's 45 for me, 36 for Patrick. He's got a little bit of catching up.
I got to make a comeback.
You got to make a comeback. And so, you know what? I was thinking about what I was going to do, which one I was going to trade. And this is what I'd like to do, Patrick. I'd like to pull up the 2-year note.
Ooh.
Yeah, a little spice.
ZT. We're going from one bond to the other.
Okay.
All right.
Okay. This is what I'm going to do. I'm going to give you a chance to win on either knockout, meaning that if it touches this one or that one, it doesn't matter which one it is, you win.
So you're basically, it's a bet on whether it's tight range or whether it's volatile. Okay.
On the downside, it's going to be 101.04.
It's flat. 04.
Yeah. And then on the upside, it's going to be 102.01.
Sorry, 101.
04.
04. Okay.
And on the upside, 102.01. And I priced it out. That's actually very fair. I have not.
And this is a 2-week bet.
2-week bet, baby. All you gotta do is touch it. Just touch it.
All right, I'll take the bet because you know what, and I'll take it for 3. But like, there's enough news. Like, I mean, we got jobs coming out. Their inflation numbers are going to be all within that span. There's enough things that can move this. Okay, I'll take it.
Okay.
Of course, this time it's not going to fucking work.
No. You know what though? That one's fairly priced. You should be taking that one.
The fact that I'm letting you convince me that it's fairly priced without me verifying. But anyway, I like it. All right, I'm in. I'm in.
101.04 and 102.01. There's an extra digit there, so it's not 102.001. It's 102.01010. Just so you understand.
Okay. Yeah.
Okay.
All right.
Is that it?
So let's move on and
no stupid questions.
Yeah, there is no stupid questions.
Almost
Lena,
forgot,
come on and
didn't you?
save us.
All right. So first question here. Market Huddle team, great work on the addition of MH Plus. I love that you hold yourselves accountable for predictions made, right or wrong. The industry is ripe with wannabe prophets looking to be the next Michael Burry, but rarely will anyone revisit their predictions. Keep up the humility. Let me preface my question saying that I am categorized as a retail trader as I am a business owner by profession with no formal financial education or certifications. However, I've run a profitable quant-based strategy for several years, and as an entrepreneur, I'm wondering how best to exploit it beyond a personal account. I don't have delusions of being the next Jim Simons or Buffett, but even they started somewhere. So hindsight being 2020, I wonder what would they have done differently to accelerate profits, knowing that they would have decades of vast success with their strategies. Of course, asking them is unlikely, so I'll have to settle with you guys as second best. So now my questions. A, assuming that it was known that we were going to be a top 50 trader, and B, you were in my position as a retail trader, what would be the most profitable path to exploit your method? Would you start a fund and prove yourself as Buffett did? Is there a reasonable likelihood as a retail trader to monetize a trading system under the umbrella of a larger institution? I realize this is a broad question and really appreciate your feedback, whether on or off the air.
Okay. Do you want me to do it, Patrick?
Yeah, go for it, bud.
Okay. This is a great question. I appreciate it. The thing I would say is that often folks underestimate the work, the non-trading work that goes into starting a fund. And I've had lots of buddies that gone and said, like, they started a fund and they end up, whether it be compliance or whether it be marketing, they end up spending way less time doing their trading than they ever wanted to do. And one of the things is you could have the greatest returns in the world. If you're a crappy marketer, you're not going to get any funds. Or if you don't have the right compliance, you're not going to get any funds. So one of the things that I would say in terms of if I was someone that was more quant-based, had a great strategy, was trying to figure out how to exploit it best, I would try to find that kind of already established hedge fund or, family office that is sophisticated, understands risk, understands what, the strategy why it might work and why they would make sense for them to partner with you and to let you run it. And that's what I would do. That's how I would go about doing it. I would try to find, instead of finding a bunch of clients to start a fund, I'd try to find one.
All right. I agree.
And then from there, by the way, if it works, and then you can always go a lot of strategies that start as like individual strategies of family offices eventually go out and become bigger funds. But that would be what I recommend.
All right. Lena, next.
Next one here. Longtime listener here. I trust Kevin's trades, but Patrick's timing. For entertainment purposes, could Kevin pick a trade and Patrick say when he would slap it on with exits and time frame?
Oh, that's a lot of pressure.
That is a lot of pressure. But, did you check this before, Patrick?
I did.
Okay, so, here's one. Let's do the euro yen. I like it. I like the short euro yen.
You want to short the euro yen?
Yeah, and I know you were telling me it's too early and stuff. That's probably correct.
Okay, so yeah, it's too early.
Okay, so tell us. Give us what it would take for you to get bearish.
Well, you just want to see that the price action is demonstrating some form of distribution. Like you could be a rock star and try to catch the highest price. But the thing is that fighting established trends is always painful, and it can last much longer than you can usually hold on. And so what you're looking for is when there's evidence that the trend has actually changed. But look how fast that reversal candle came in today. It's like one breakdown candle and then it just slingshots the other way. That is not the type of price action that you would typically see on something that is already being actively distributed and reversed. But one thing that I would be looking for is after this rally that we saw today, will it fail to follow through? Because really at this stage, the bulls, if they're going to keep the bull run going, have to use this type of a 5-day pullback to slingshot it back to the highs, and then it can make a run for 160 or 162. If we start seeing that rallies are being sold and it gets a toppy and very distributive, then you could start leaning into it. It might develop, but I would say first just watch to see whether or not this rally fails in the coming week. There you go.
That's probably correct.
All right, last one.
All right.
Kevin and Patrick, really enjoy your show. Some popular FinTwit personalities are saying at this point in the cycle, the play is to be short stocks and long calls. A couple of questions. I understand this strategy if you manage money and have a mandate to stay invested. But if you're an individual investor and you believe directionally the market is more likely to go down over the next few months than go up, why not just go to cash and take a 5% return on your cash? Separate but related question is, how do you size your hedges? If you're an individual investor and have $1 million investment portfolio, should you really hedge the entire portfolio? Again, I can see hedging individual positions, but struggle with how to size hedges on your entire investment portfolio. Any guidance would be great. Thank you.
I'm going to let you do this one, Patrick. This one seems like it's up your alley.
Yeah, well, you can also contribute on it, but generally, the first observation is that of course if you're an investor that has a mandate, or if there's substantial tax consequences to let's say liquidating your portfolio, and you have a huge tax disposition and other issues like this, then obviously constructing hedges around your existing positions is often a more effective way than to liquidate and go to cash, right? The one thing in terms of how do you size your hedge is very much dependent on what you are trying to hedge. Like, are you trying to remove all risk of loss, or you simply want to blunt left tail risk where, if the market's down 30%, you soften the blow and are only down 10 or 15%. You obviously, hedging costs money, and so the more risk you want to remove, the more costly it is to be hedged. And so this is a very personal thing depending on what you're trying to achieve, right? Do you generally agree with that?
Yeah, well, and the other thing I would add, Patrick, is that when he says that some FinTwit personalities are saying at this point in the cycle, the play is to be short stocks, long calls, is that like on a 1-for-1 basis, or is that on a delta hedge basis, which will be dramatically different kind of payoff profiles in terms of how it would work? And so one thing is, if you're doing short stocks, long calls on a 1-for-1 basis, you're in essence just buying puts. So
yeah, it's a synthetic put,
I don't
right?
know if that's what they're saying. And if they're saying you should just buy puts, then why not just go buy puts? So let's assume that's not what they're saying. Let's assume that they're saying that you should be short stocks and long calls. And let's let's just imagine it's at the money and you're doing a kind of 100 calls against short 50 stock. I think the reason they might be arguing that is because the moves to the upside have been somewhat violent in terms of some of these moves, and we're getting these big spikes. And so if you do that and let's just imagine you had that position on and then you got a big run to the upside, then you could in essence go and actually short the other 50 of your call underline that you haven't hedged up against your long calls. And then you would be long puts from a different level. It ends up being the same though. Like, why not just trade the puts properly and trying to make it fancier by doing short stocks and long calls? I don't see the kind of attraction to it.
Yeah, it doesn't make sense either. And not only that, because of the interest rates levels, the call options generally are on the, have to discount these interest rates, which make them generally more expensive. And so it's not it has a pretty clean carry cost to putting that trade on.
And the other thing in terms of like how you go and hedge it in terms of how much, let's just say you have $1 million of stocks, but you're going to have $1 million of stocks in your particular portfolio that might not behave at all like the S&P 500 or whatever index you're doing. So it's always a difficult call, and there's really nothing to kind of help you with except for you need to sit down and think, okay, well, if this happens, would I be happy with this? Or if this happens, would I be happy with this? And one of the things that I will just warn about is that the moment you start using an index against your individual positions, expect your individual positions to go up, down, and the index to go up, because it just seems to be that like putting that sort of what they call basis risk is just a kind of a nightmare.
All right. Well, Lena, if anyone wants to submit questions, where can they submit them?
So if you have any questions for Kevin or Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give Lena a follow at the Market Huddle on Twitter. She's there and she gets tired of talking to Patrick and myself. You guys know where you can find us. Please give us a review. We appreciate it. Patrick, where can they find you?
You can find me at bigpicturetrading.com and or on Twitter at Patrick Ceresna. Kev, where can they find you?
For me, you can go check me out at themacrotourist.com, and you can go /chat if you wanted to come in to join our great group of folks that are lovely and want to talk about the markets all the time. So listen, we can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show.
All right. So let me start off just by rating this beer. Surprisingly, it's a little bit more on the bitter side for what you would typically see in a Pilsner, but it drinks very smooth. This is like a beer where you could literally buy a 6-pack and sit down and drink it. It's actually a good beer. I'm gonna give it a 7.9.
You didn't say sessionable.
Oh, I was waiting.
I was going to, but you know what? I was like, "Fuck, they're gonna call me out on it." And and there you go. You call me out, even though I didn't use it. It's sessionable.
It was implied. I'm drinking your Chela de Playa. It's actually a pretty good beer, Patrick. Is this from like your neck of the woods there in Mexico?
Yeah.
Yeah, it's a local one.
Yeah, it's not bad.
Why are
not bad?
They got a picture of a turtle in there. They didn't use turtles in this, did they?
No, you're not drinking a turtle.
By drinking that, you're saving a turtle.
Oh, that's it.
Maybe that's what it is.
Speaking of eating exotic animals that are,
yes,
Patrick.
Yes.
Do you have any new meals that you want to share with us? So
I'm in Italy.
Yeah.
And we go to this nice little restaurant, and they on the menu they had donkey. I had donkey.
You forced it. You it was on the menu, and then you're like, oh great,
No, I'm gonna do it. But it was,
so you're just like, I'm gonna eat some donkey.
It wasn't just donkey. It was donkey tartare.
Oh.
I literally, and you know what? It was spectacular. They're such cute animals. I feel so bad.
You ate Eeyore?
Yeah.
It's worse than that. He ate this guy.
Next.
He ate the talking donkey from Shrek.
Oh.
I'm convinced that's who you ate.
I probably did. But you know what? It was very good. I'm
What
not
does it taste like?
It actually it's right in line with beef. I mean, it's it's not gamey or anything. It's
Tastes
not
like
gamey or
fish.
anything. It's delicious.
Everyone, when they're watching Shrek and they see the donkey, just think about Patrick.
But
eating
you-
them.
You know
And
what
the,
though?
And the poor dragon, like with those kids. 'Cause remember the donkey married the dragon.
Oh, if there's any new listeners out there listening to this right now, they're just like, what is going on?
No, like,
We should
But
probably
you know what,
preface
like-
this about previous exotic.
Out of what blows my mind is, like, out of all places where I'd found it was in Italy. Like I was in Morocco, and like you would have thought, like where they have wild donkeys everywhere, that you'd try something in a place like that, and it was.
Patrick, you're gonna get yourself into trouble saying shit like that.
Listen,
I did
all
not
I know.
say that. Send all your hate mail to Patrick.
Anyway, it was delicious. It was delicious.
God, the
All
poor
right, so let's
donkey.
change that.
I'm trying to find the part where he talks.
So you ate an ass.
Here he is, the donkey. Like he just.
I ate ass.
Yeah.
This is it. This is the donkey and Shrek.
You there, ogre? Aye. By the order of Lord Farquaad,
You know what? I love this movie.
place you both to arrest,
Yeah, we can tell.
transport you to
I'm playing all of this.
designated resettlement.
So just think about this: the next time you listen to
really?
Mike Myers
You and
and the
what
donkey,
army?
think about Patrick eating them. Okay, Lena, anything new and exciting?
I'm planning to go to Japan at some point.
It's a new trend.
Yes,
Yeah.
new trend. So hopefully, once that's finalized, I can share more details. But I don't have
Share
any
more details. Everyone's going to Japan.
more details yet.
It's the cool kids. Once the cool kids start going,
Yeah,
right.
no,
Some
I
gentleman told me
actually,
it was a great place.
it is a great place. Lovely.
I do want to go. But I don't have any plans to go anytime
They're
soon.
not
But
letting you in because they're like, that guy's a donkey eater.
How rude!
oh, come on. Okay.
Oh, for those who don't know, Patrick has a long history of eating questionable animals. At least he didn't shoot the donkey himself this time. For those that weren't aware, Patrick likes shooting squirrels and eating them.
Oh my God, that happened once.
Don't
That
lie.
happened once.
This week.
Yeah, that's once too many.
This week. What do they think in Portugal when you want to shoot the squirrels and you're like, that looks like a good one?
I don't got a gun out here.
What? By the way, what is the? Wait, there's somewhere in South America that they eat basically like guinea pigs.
Really?
Yeah, and they eat these
What's
guinea
there
pigs,
to eat?
and they put them on a skewer, and you can actually get them. I think in New York City and some places.
No, those are
Really?
rats.
No.
Yeah.
Guinea
Yeah,
pig
New York City
eating-
rats.
New York City rats.
No. Eating guinea pig. It's not a guinea pig, but it's like a guinea pig. Let me just. It's Peru. Here we go.
Well, there's our next destination, Pat. You're going
Yeah,
to
there
Peru.
you go, buddy. And then you can do it, and Peruvian guinea pig delicacy.
Wow.
And some places in New York, they like have them like a hot dog stand, but instead they have these
Really?
things. Yeah.
Wow.
Oh my God, these look nasty.
I haven't been to New York in a while.
These are nasty. Oh, should we put this in the show notes?
Oh, maybe not. I don't know.
Oh yeah, you got to put this in the show notes. Okay, I'm going to put it here, Lena. I'm going to give you the link. Make sure you put
Oh,
that in
brother.
the show notes.
Do I even want to open it?
Of course you want to open it. Patrick's like,
Let me s-
"Hmm,
that-
look at that. My squirrel
oh
barely
my God,
got
that looks
any meat."
delicious.
Oh my gosh.
That looks so good.
Actually, it doesn't look that bad.
They look like rats, though. They do.
You know what? If you put aside the face, which is a problem with almost everything when you're eating it, is the face. But if you put aside the face, it actually looks fine, and it looks like it's
gosh.
like it's barbecued in a nice way. Like I got A+.
It's cooked well, but gosh,
Yeah.
that's
You're like, you know what?
Do you think
being a Canadian boy,
Yeah.
I'm used to and I've always eaten shrimp without the heads on them. And like when I got to Portugal, they serve their seafood with the shrimps with the heads. It took me a while to
everywhere
get used to.
They like putting the faces down there.
And just getting used to eating shrimp with the head still on. For a while, I was like, ugh.
Yeah.
But now I'm totally good with it. But like, that was you're right. Like once the heads are on there, it changes.
But it's way more fun to play with. Get your fish talking to the other little fish.
Jesus. On that note.
Have a great couple of weeks, everybody. Don't buy too many 2 years or sell too many 2 years. Leave them there.
All right.
See you guys later. Bye-bye.
All right. Take care.